Ladies and gentlemen, welcome. My name is Artem. I'm a CPA and the managing partner of Torn Accounting. Welcome to Tax Time. Today we'll be discussing retirement options that are available to you if you are self-employed with no employees and you file a Schedule C on your federal income tax return. A Schedule C is eligible for those that are either unincorporated, no entity level structure set up, or if you're a single member LLC. And an important distinction for this video is that we are assuming you have no employees and you yourself are not on payroll, which you shouldn't be if you're filing a Schedule C. So there's no payroll at all associated with this business. It does get a little more complicated if you do have employees. The four accounts we'll be discussing today is a traditional IRA, a Roth IRA, a SEP IRA, and a solo 401k. So let's begin, and let's start with the traditional IRA. So traditional IRA is not directly tied into retirement planning for self-employed individuals. However, it is a crucial piece if that's your single source of income. So traditional IRA can come in two forms. You can have a deductible IRA, traditional, or a non-deductible. That depends on your income limits and how much net income and adjusted gross income and taxable income you are showing on your tax return, and whether it makes sense to do traditional versus a Roth. So let's start off with the traditional IRA. The limit for 2025 was $7,000. The due date for that is 4/15 of 2026. That one you cannot extend. The traditional IRA, like I said, can be deductible or non-deductible. So if it's deductible, it actually reduces your income, your total income, not your business income. And important, it's not a deduction on your business, it's a deduction against your taxable income on your federal income tax return. And so those limits are, let's cover those real quick. So if you're single and your total AGI is less than $77,000, then you'll be able most likely to take a deduction for a traditional IRA. It starts getting phased out from there. The full deduction gets phased out at $87,000. If you're married filing joint, it's a little bigger, so it's $123,000. If you're under, you're good. You should be able to deduct it. The phase out starts and then it's fully phased out over $143,000. So for example, if you're single and your income is $100,000 that you're showing on your tax return as taxable income, most likely there's not going to be a deduction for a traditional IRA. However, you do need earned income. So you need at least $7,000 of earned income to put into a traditional IRA. And that's going to save you, this is very important, only on your federal income tax rates. It's not going to reduce your self-employment tax, which is completely unrelated to this calculation because this is not a business deduction. If you're over those income limits, you can still put money into a traditional IRA. It's going to be non-deductible. However, there's probably better avenues for you to take if your income starts climbing versus a traditional IRA. Roth IRA also has income limits when you can contribute directly to a Roth IRA. However, there's no deduction for contributing to a Roth. The basis that you put in there, your contribution is post-tax, and all of your earnings, provided you meet all the distribution requirements, should be tax-free as well. There's limitations, again, to income, to your AGI, based on, that's your adjusted gross income, on when you can contribute directly to a Roth. And those are, just real quick, $146,000 is if you're under that for single adjusted gross income. You should be good with a Roth IRA if that's what you choose to be. That limit is $230,000 for married filing joint. And then it gets phased out at different incomes above that. There's also, if you're phased out of a Roth IRA based on your income, however, you can still make the traditional, as we mentioned. There is a backdoor Roth conversion that is available. That's out of the scope of this meeting. That is definitely a tax strategy available. My best friend, Mike from Woburn, Massachusetts, likes to make the cream in the coffee analogy. Again, we won't touch on that there. We'll make a dedicated video to a backdoor Roth contribution for a tax year. So next, let's talk about SEP IRA. Now that is specifically tied to having self-employment income. So the first two, the traditional and the Roth, you do need earned income. It can come from self-employment, but not necessary. A SEP IRA is tied directly to your self-employment income. For our purposes, we're a Schedule C, as we mentioned. So you have to figure out what your net is, right? So it's your gross income minus all of your expenses. Your CPA will take care of that. We'd be happy to take care of that for you. You get at your net income level. From that net income, it's give or take 20%. The calculation is a lot more intense, and I'm not going to do the mental gymnastics here during this video, but let's assume it's 20%. So if you had $100,000 of net income, so your gross minus expenses, your net is $100,000. your contribution to a SEP IRA that you'd be eligible to is about $20,000. That again is going to reduce your federal income tax. Not self-employment. This is not a business deduction in that sense, but it will reduce your taxable income and save you on federal income taxes and states where that qualifies. Now the next option, and this is kind of the best option if you're trying to sock away the most amount of money that you can in a single year, and your income is lower, the way you can contribute the most amount is typically through a solo 401k. So a solo 401k is the same calculation that we just discussed with the SEP, where it's a percentage of your profit, right? So kind of like profit sharing, think of it in those terms. That is still about 20%. However, if you've ever been with a company where you are contributing to a 401k, you can also do this here, even though it's your business. So you have your employee contribution, and then you have your employer profit sharing match. So under that same $100,000 example is your net income. The SEP IRA would be about a $20,000 deduction. A solo 401k would be about a $43,000 deduction. So with the lower limits, if you have enough cash, solo 401k is most likely going to get you a higher retirement contribution and most likely going to get you a higher tax savings. A couple of important distinctions. The profit sharing contributions on both the SEP and the solo 401k can be extended along with your tax return. So the due date for those is not 4/15, but it can be extended if you extend your personal return by 6 months to October 15th of the following year, right? So we just wrapped up 2025. So you could extend your personal tax return, and those contributions to your retirement plan won't be due until October 15th. It's a pretty good way if you need some extra time to save up some money for the retirement contributions that is available. Unlike the traditional or Roth IRAs, those are due with the tax filing. So for 2026, April 15th is coming up. So your contributions for 2025, so you can make them for 2025 still, are due April 15th. The SEP and the solo 401k will most likely be able to be extended as long as you make those before the tax filings and the returns. SEP IRA is the easiest account to set up most likely in terms of logistics. And another question that we get is, where do we set this up? Essentially, it can be any place that opens up bank accounts. Most banks will offer SEP IRA options. Solo 401ks, specific providers, so you want to reach out, and we'll happy to let you know who we work with and who we recommend for ease of use. Again, all of these things do not reduce your taxable income within your business. However, they will give you deductions on your federal income tax return and state, depending where you're at and if the state conforms with it. So that's our quick and easy retirement contribution video for a self-employed business with no employees, where you are the single owner, and we'll see you at the next one.